economy. Now, Bill Gross, founder and co-chief investment officer of PIMCO, the world's largest bond fund, is also warning that the Fed and Ben Bernanke are now overdoing it. In his latest monthly investment outlook out today, Gross says, quote, "It's been 5 years, Mr. Chairman, and the real economy has not once over a 12-month period grown faster than 2.5%. Perhaps in addition to a fiscally confused Washington, it's your policies that may now be part of the problem rather than the solution." Bill joins me right now for an NBC exclusive. Bill Gross, good to have you on the program. Welcome.
Hi, Maria. Thank you.
So where did Bernanke go wrong? Is it just too much quantitative easing at this point?
Well, perhaps too much check rating and perhaps too low of a policy rate. In our opinion, Maria, when you bring interest rates down so low to the zero bound, so to speak, you basically reduce the incentive on the part of investors to take risk. I mean, your risk comes in numerous forms. It comes in the bond market in terms of longer maturities, what we call duration. It comes in terms of risk spreads, speaking to high-yield bonds. It comes in currency space. It comes in volatility space. It comes in the equity market in terms of an equity risk premium. But when you lower those premiums so low, and it's most visible, obviously, in the bond market when you get yields close to 0%, then investors have a proclivity perhaps not to take additional risk, not to buy high-yield bonds and stocks, but perhaps to come inward and be more conservative because the risk is too great.
So let me get your take on the investment outlook. You've got your new investment outlook out today, just released. What kind of a year are you expecting for the markets?
Well, going forward, the bond market and at the tail end, the equity market, had a stinker of a month. Going forward, to my way of thinking, with 10-year treasuries at 2.15, they're perhaps well set up to deliver that type of return. It was a negative month, for bonds in May, but going forward, if yields move to an appropriate level, and that's the key, and the appropriate level is dependent to some extent, Maria, on what the Fed does, whether they taper, what inflation does, and what growth does. To our way of thinking, growth remains muted. The Fed continues to buy bonds, although at some point they begin to taper. But that means that the 10-year Treasury, as indicative of the bond market, the high-quality bond market, it means basically that you can begin to earn that return as opposed to, suffer some principal loss. It's the end of a bull market, perhaps, but the beginning of a period of time in which, safe carry and safe return can be garnered.
Yeah, I mean, definitely the conversation has now shifted as to when. Is it going to be this June, this year? Is it going to be the end of this year or next year that the Fed starts tapering its bond buying program? You've got to make a bet. What's your bet?
Well, our bet is that eventually, later this year, that they begin to taper for several reasons. One, it is growth and unemployment dependent, and we're going to see more this Friday. But absent that, it's also dependent upon, several other conditions. It's dependent upon the lower budget deficit. Let's face it. If the Treasury is only issuing $600 or $700 billion worth of Treasuries going forward, then the Fed, in terms of its purchasing, probably has to cut back in terms of those purchases. And so that's something to factor in terms of the tapering, a lower budget deficit. It's also dependent to some extent on the negative aspects of quantitative easing raised by Esther George, raised by Mr. Fisher at Dallas. There are negative aspects in terms of these zero-bound interest rates that are filtering out into the economy and stagnating, keeping growth down as opposed to raising interest rates. Just to finish the thought, Maria, Chairman Bernanke and other central banks basically have been working with this model that if you raise asset prices, that eventually it filters down in a wealth effect to, stimulate the real economy. That really hasn't happened, as you pointed out in terms of my outlook. 2.5% growth, from trillions of dollars worth of check rating, I think it's suspect.
Yeah, actually, it's pretty extraordinary. But, I feel like Bernanke's bailing out policymakers. If Bernanke weren't there, we wouldn't have any stimulus, right? Where's the stimulus coming from the fiscal side of things? And would you like to see that replacing some of this bond buying?
Well, we've always been an advocate of fiscal stimulus to the extent that it was appropriately directed. To our way of thinking, up until this point, it's been directed towards consumption, and consumption has its day, and then it doesn't have its day. If the stimulus was directed towards investment for the future, in whatever area that you want to claim, then it has more longevity and more staying power. So our proposition has been to stimulate investment as opposed to put it into consumption.
How does Japan play into this bill? I mean, is the Fed at all constrained by the Bank of Japan's massive bond buying? How do you think that plays into this?
Well, it does. With the yen going down, that means the dollar goes up in terms of the trade balance between the two, at least. And a stronger dollar, perhaps is good from the standpoint of the historical strong dollar policy. But basically, it slows down U.S. growth and U.S. exports. We've seen a 5 to 6% appreciation in the U.S. dollar over the past 6 months. Is that good? Well, it reflects a stronger U.S. economy, but ultimately it means that our exports slow down and that the U.S. economy is affected. So what's happening in Japan in terms of check writing, in terms of QE, in terms of a sharply lower yen, ultimately affects not just the U.S. but the rest of the world. Japan, in effect, is exporting its deflation to the rest of the world, and that's a simple but important concept to remember for investors.
All right, Bill, we'll leave it there. Good to have you on the program as always. Thanks so much.
Thank you. You're welcome. Thank you.